Hello everyone, welcome to our Egyptian online seminar group. First, keep it conserved, then if you have any questions, you can ask our speaker after his presentation or during his presentation. I have great pleasure of welcoming dear Professor Edward Altman. Edward Altman is one of the top thought leaders in the world. He is a professor of finance emeritus at New York University and the director of the credit and fixed income research program at Salomon Center. Dr. Altman has an international reputation as an expert on corporate bankruptcy, high-yield bonds, distressed debt, and credit risk analysis. He is the creator of the world-famous Altman Z-Score models for bankruptcy production of firm globally. Dr. Altman was named one of the 100 most influential people in finance by Treasury and Risk Management magazine. Now we will start our seminar with dear Professor Edward Altman.
Thank you very much, Mohammed. Good afternoon or good evening or good morning to everyone. It's my great pleasure to be with you today, and thank you, Mohammed, for the introduction. It's also a great pleasure to find that we have representatives on the line who are from many parts of the world. It's been my pleasure to be with you now for at least 1 hour and perhaps with questions afterwards. If you have time when you're watching, it would be nice if you put in into the chat box perhaps your name, but that's not important, or it would be okay, but also what country you're from and what institution you are with in that country, whether it's a university or a bank or other institution. I like to know something about my audience when I'm speaking. Today, I'm going to be talking about a subject that I've been following for many years now, and I'd like to bring you up to date on two main issues, actually three when you think about it. First, I'm going to introduce you the concept of a credit cycle. Also we'll talk about the leveraged finance industry. What I mean by leveraged finance are companies, non-financial companies, who borrow money from various institutions, and they're called leveraged finance because these companies are generally highly leveraged, and as a result, their credit rating, if they have one, is non-investment grade or high yield or sometimes called junk. But these are companies who are legitimate companies in the credit markets, and they are an increasingly important segment of the credit market. And finally, we'll be talking about the rise of what is now called private debt. Private debt is defined as loans from non-banks or shadow banking or private debt. And this is by far the fastest growing segment of the global market for corporate credit. So those are the main topics. Before I start, let me ask you a question to think about, and then we will return to it during my discussion. But I'd like you to focus on this question in your minds so that we can, when we discuss it, you might have some points of view or some insights that we can share together. Many of you, or most of you, perhaps all of you, are familiar with the concept of a business cycle. Expansion, recession, GDP growth, unemployment, trade deficits, things of that nature. Every day the newspapers are full of discussion of the business cycle, whether it's on a global level or more likely on a domestic level. But how many of you, if you were asked, can define and understand the credit cycle? And so the question that I'd like to ask you is, one, we will, during the discussion, focus on the credit cycle and my very simple way of defining that cycle. But the question I'd like you to focus on is, if you compare the credit cycle with the business cycle, which one, if any, leads the other in terms of timing of change? In other words, does the credit cycle lead the business cycle, or the business cycle comes first in change and that promotes changes in the credit cycle? Or are they coincident? Do they move together more or less over time? We will explore this later on in the discussion. Another question has to do with the concept of default rates, recovery rates, loss rates. And so a question that I will focus on is how to define defaults, how you measure it, but also the question is, are there differences in default rates if you compare it with bank loans versus non-bank loans? And what does the current data show? So those are a couple of questions that we will pursue together, but there'll be many others. Next slide, please. So the next slide deals with the global debt picture. Mohammed, next slide, please.
Okay.
I'm not seeing you changing it. Okay. So first, I'd like to present to you a very simple way to define and understand the credit cycle. You can see that there are 4 levels that deal with credit availability, default rates, etc. Benign, well, a benign period means basically easy credit, low interest rates, lots of liquidity. If there are defaults, the recovery rate for the lender is quite high. And in general, a very positive and easy market for raising debt for companies of all different levels of risk. If things become a little bit more difficult in terms of credit availability, in terms of defaults, in terms of recoveries, then we have an average period. And what I mean by average is, if we look historically, and I have lots of data going back maybe 50 years, at least in the United States, what do we mean by average in terms of some of the metrics that I look at? Defaults, recoveries, liquidity, etc. If things really become much more difficult, defaults increase, recoveries decrease, liquidity begins to dry up, and companies have lots of problems, both in terms of meeting their fixed income obligations, but also raising new debt, then we're in a stress situation. And then finally, if we have a very difficult situation, perhaps default rates of 10% or more in an asset class, or almost no liquidity available, markets are stagnant, then we have a crisis. So we'll return to this spectrum, but think of the credit cycle as a spectrum from easy, benign to a crisis. Next slide, please. The next slide is looking at global debt, and these are the way that most central banks, most macroeconomists define the global debt picture. So we have 4 categories of global debt. The left category, non-financial corporates, is the area that I spend most of my research speaking and consulting on. These are companies who borrow money, but they do not include banks, insurance companies, brokerage firms, and the like, mainly non-financial corporates. Next to that, we have government debt of all types, but mainly the federal government of each country raising debt to finance their operations. Then we have the financial sector, banks mainly, but also non-banks. And finally, on the right-hand side, we have something called household debt, or mainly mortgages of people buying homes, buying automobiles, buying refrigerators, anything dealing with consumer debt. So the reason why I show this picture and the summary on the right-hand side of the amount outstanding globally is the fact that you can see very clearly that in the last 30 years or so, from 1997 through actually today, there's been a dramatic increase in global debt. For example, non-financial corporate debt on the left-hand side has risen from about $22 trillion to about $100 trillion globally. And another way of looking at debt is relative to GDP, whether it's the country or in this case, the global GDP. And it has risen from 64% of global GDP to about 100%, very close to 100%. So an enormous increase in corporate debt. Now, that is potentially providing a problem, especially when interest rates rise or the economy goes into a recession or the economy has problems in specific sectors. But we will return to that. Government debt also similarly has grown dramatically in this period, even before COVID, but certainly including COVID, from about 19 trillion to now close to 100 trillion as well, and about 100% of global GDP, including, I'm going to talk about the United States, which has an explosion in debt of all types. Financial sector debt increased dramatically prior to the great financial crisis and now has leveled off mainly due to regulation from central banks, which require banks to have more equity, more reserves, and less debt, or about the same level of debt. So the level of debt today of global banks is about 80% of global GDP. And that has not changed really since 2007. Finally, household debt, which was the catalyst for our great financial crisis, which started in the United States and spread throughout the world, that grew also dramatically until about 2008. Then we had the crisis, and that has leveled off at around 63% of global GDP. But still, it is an issue in some countries. Bottom line, a dramatic increase globally in debt. And I'm going to come back to that issue when we discuss the current situation. Next slide, please, Mohammed. For example, in the United States, the US government now pays more than $3 billion per day in interest costs for several reasons. One, and main reason, is the dramatic increase in US government debt, treasuries, globally. Second, higher interest rates in the last few years. You put the two together and you have an exploding amount of debt, interest payments. We estimate it's over $3 billion a day now, and it will go up to 4 or 5 billion based on current estimates. Well, is that a problem? Yes and no. it's not a problem as long as the US government dollar is a world currency, and most people use it for trade and for investments. However, more and more, the US government has to pay a lot of interest, which means they have less money to pay for other things. But if they do spend money on other things, as we're doing right now, then the debt to GDP ratio of our country will increase dramatically. Right now, our total debt, government debt, is about 100% of GDP, about $34 trillion in debt and GDP. It's expected to rise beyond that in the next 5 to 10 years. And perhaps that could provide a problem if investors, both foreign and domestic, require higher interest rates because of the need to raise more debt. Next slide. This looks at total foreign holdings of US equities, treasuries, and credit in general. So right now, foreigners own about 20% of our equity markets, 30% of our treasury bond market, and 30% of our corporate debt market. Well, that's not a problem as long as the foreign investors continue to want to hold that debt. If there is a problem in the US government situation, then this could lead to problems in the selling of new debt and the interest rates we have to pay. And there has been some talk about that recently as the US debt levels continue to increase. Next slide. This might be quite interesting and different from what you are experiencing in your own country. Think about how much private credit, how much corporate credit is provided by banks. Most countries, Mohammed, I would guess Egypt, but think about the countries that you're all from. What percentage of corporate debt is provided by banks? My guess is it's well more than 50%, maybe 70, 80, 90%. But in the United States, believe it or not, it's only about 20%. And 80% of corporate credit, mainly to non-investment grade companies, by the way, is provided by non-banks, financial institutions, what's called private debt lenders. And I'll talk more about that in a moment. So the fact that banks only are providing 20% of corporate credit means that they are less important to the credit cycle than they are in other countries. But my guess is the trend in most countries is going to be less debt provided by banks and more by non-banks, especially in developed countries. I'm less familiar with that situation for developing countries. And by the way, what Mohammed didn't mention about my current interests and background is the fact that I'm also co-founder of a credit analytic firm based in London and Mumbai called Wiserfunding. And we have many, many clients who are non-banks that use our services to assess the credit risk of small and medium-sized firms. So if any of you are with institutions or no institutions that have a large portfolio of small and medium-sized firms, you might be interested in our credit analytics, which is both fast, accurate, and not very expensive. Next slide, please. You might be interested in our corporate debt markets, bond markets. The US corporate bond market is dominated by A and triple B level firms. And you can see the amount there, 4 trillion and 3.8 trillion. However, if you look on the right-hand side, you see double BB and triple C. If you add that up, it comes to about $1.5 trillion in corporate bonds. However, non-corporate bonds, non-bank loans dominate in this non-investment grade market, which I'll explore in a moment. Next slide. Let's talk about the leveraged finance market. Again, leveraged finance are loans to non-investment grade companies. And by the way, globally, the vast majority of companies, if they were rated, would be non-investment grade, double B, B, and triple C rated. But of course, most firms are not rated by credit rating agencies. They're not big enough. They don't want to pay the cost of a rating, and their markets are very much more restricted. However, there is a dramatic increase in corporate credit globally, as I mentioned. So let's explore in the United States, to start with, the size of the so-called leveraged finance market. High yield bonds, that's non-investment grade bonds, a market that I've been following since its inception in the late 1970s, early 1980s, is about $1.5 trillion. Leveraged loans, or broadly syndicated loans, BSLs, in the United States are about 1.2 trillion. This is an expanding market, and one that most bank loans that are broadly syndicated and sold out to the public are now part of what's called CLOs, collateralized loan obligations, which are packages of these loans sold to financial institutions. They are rated, they are followed very carefully, and they provide a fair amount of liquidity, especially for non-investment grade companies. And finally, we have what's called direct lending, non-bank loans, or private debt, which is one of the subjects of my talk. And here you see that estimates are between 1.8 trillion and 2.5 trillion. I think it's closer to 2.5 trillion, if not even more than that now, although some investment banks are estimating that market to be a little less than 2 trillion. But notice it's larger than either high yield bonds or leveraged loans. And it is the fastest growing part of the leveraged finance market. Overall, about $5 trillion in the United States in what's called leveraged finance. So I'm going to come back to that segment very soon. Next slide. Here is the traditional way of looking at ratings, from investment grade at the top to non-investment grade, high yield, or junk at the bottom part. I personally follow much more the non-investment grade segment of the market rather than the investment grade, because that's where the action is with respect to default rates, recovery rates, stress on the financial markets, and interestingly enough, the metrics we use for the measurement of the credit cycle. Next slide. That just shows the growth of the high yield bond market, which is now leveling off to around $1.5 trillion. And you can see that the market back in the late 70s, early 80s was minuscule. And it's about that time that I got involved in making recommendations to one of the large investment banks, Morgan Stanley, as to whether or not they should enter this market and compete with the market leader at that time, the firm known as Drexel Burnham. You may have heard of Michael Milken and the pioneering work that he did in building a market for non-investment grade companies to issue bonds. And by the way, I've been following the growth of small and medium-sized firms issuing bonds in other countries, particularly Italy, which has what's called a mini bond market. So in Italy, you can be a company that's small or medium and actually issue bonds that are small or medium-sized. They're called mini bonds, but they are sold directly to the public through underwriters, just like much larger companies issuing bonds in the high-yield bond market. Next slide. Okay, let's move to some descriptive details of the private credit market. As I mentioned, this is by far the largest growth area in the corporate debt market, particularly non-investment grade companies. Next slide. You might be interested to know that in the United States, for companies greater than $100 million in liabilities or assets, that 87% of firms of this size are privately owned. Now, most of the people who are listening are from countries where maybe the privately owned sector is even more than 87%, because very few companies in most countries are rated by the rating agencies or are publicly owned by in terms of the equity of the company. So, but it's interesting because this is very important. This very high ratio of private firms is mainly because of the growth of the private equity market. In the US, it's an enormous market. Well more than 50% of companies are actually owned by private equity firms and part of their portfolios. And these are the major borrowers in the private credit market. Less and less are these companies going to banks for their financing, but they're going to what's called private debt issuers. Next slide. This shows the US private credit as a share of total debt. That number in 2023 was about 6.6%. Now it's probably more than 10%. More than 10% of corporate debt is provided by private credit firms. And I'm talking about all types of debt. And it was very, very little back in 2003. Next slide. This shows an estimate done by one of my colleagues at New York University, Michael O'Rourke from the law school, and he's a bankruptcy law expert. And he's been following this private credit market of late. And notice his estimate of the size of the private credit in the US has gone from about 1.2 trillion in 2018 to about 2.6, 2.7 trillion in 2024 as of the third quarter. Now, just for you, if you're not familiar with the private credit market, let me tell you about some of the firms providing that private credit. One of the largest providers are what's called BDCs, Business Development Corporations. And these are essentially hedge funds whose business is to borrow money at relatively low interest rates because they're well capitalized, or issue equity in the equity markets, and there are more than 100 of these companies listed on the stock exchange, and turn around and loan that money to non-investment grade companies, primarily companies that are part of private equity, which is by far the fastest growing non-equity type of hedge fund. And these BDCs raise money from the equity markets, they issue debt themselves, and also they have insurance products. In other words, they can offer insurance firms investments in themselves, and the returns have been fairly high, so that dividends paid out to these BDCs, whether they're publicly owned or privately owned, are averaging 8 to 10% per year, pretty much consistently since the great financial crisis. There's some concern now with a reduction in lending to private equity firm portfolios. And that's because private equity firm portfolios, due to the higher interest rates, are investing less or are having more difficulty selling the companies that they own and returning money to their investors. I'm not sure if you're following that carefully, but basically, we'll take a look now at who are the investors in private credit and what are their objectives. Next slide. Next slide. Thank you, Mohammed. This is a fairly complex looking diagram of the private credit fund structure. So at the center, there's the so-called master fund. That's the BDC, that's the hedge fund that makes the loans to private companies primarily. And these private companies are owned by, for the most part, private equity firms. They get their money from feeder funds that raise money and funnel it to the master fund. And these feeder funds are either unlevered or levered, and they have investors, and they're called limited partners. And these limited partners then invest money in the private credit industry, hoping to get their money back in 3 to 5 years and to be paid a fairly significant interest rate when they're outstanding. Many of these lenders are insurance companies, or they could be banks themselves. So notice at the bottom there are banks that provide funds to the master fund. So one big question that regulators have globally, and particularly in the United States and the European Union, is how vulnerable are banks to a problem or a meltdown in the so-called private credit area. I'm no expert on this, but people who I've talked to at this point do not believe that the bank exposure, as you can see, long-term or short-term lending from banks to these non-bank lenders, is not that significant to provide a systemic risk should there be a meltdown. However, as we'll see now, and we saw before, the amount of bank exposure is growing, as well as non-bank exposures to the master funds. Next slide. This shows private debt with lenders whose capital ratio are less than 50%. In other words, higher credit risk themselves. And notice that in 2024, there was a big increase in private credit funds that had capital ratios below 50%. That doesn't mean that they were in serious shape. It just means that if there was a meltdown, these would be the first ones to have credit problems themselves. Next slide. Bank borrowing. This is BDCs, these business development corporation, borrowing from banks. And again, you can see a big trend increase in this area. Not yet at a systemic level, but regulators are watching this carefully, including probably regulators in countries that you are from, especially if you're from the US or Western Europe. But if you're from the Middle East, you have to check with your central bank as to whether or not they are concerned with the growth of private credit, non-bank lending. Next slide. Okay, that's all I'm going to say on a primer on private credit, although we're going to come back to that issue. And this slide talks about the size in Europe of high-yield bonds, leveraged loans, and private credit. So already private credit in Europe is larger than either high-yield bonds or leveraged loans, about 430 billion, we estimate, whereas in the United States is about 2.5 trillion, so about 5 times higher in the US, but again growing a lot in Europe. And so the European Central Bank is beginning to look at the vulnerability in a downturn of the private credit market. Next slide. Next slide. Mohammed, next slide, please. Okay, now let's turn to the credit cycle. These are the variables I look at to determine where we are in the credit cycle. Default rates, recovery rates, if there are defaults, investor required rates of return. We call it the OAS spread, option adjusted spread, or what's called the bank syndicated loan average spread. High yield bond distress ratio. These are companies whose yield is at least 10% above the government interest rate. So today in the United States, the 10-year Treasury rate is about 4.3%. So any firm whose yield, what they have to pay to investors, is greater than 14.3% is considered distressed, because they have to pay such a high yield means they're higher risk. And finally, liquidity. Now, this slide, for those of you interested, when you want to look at the slides, shows you the historic average in these variables. So for example, default rates on high yield bonds have about a 3.3% historic average default rate. So that's a very important barometer to look at when you're determining the credit cycle, whether or not it's benign, average, stressed, or in a crisis. Recovery rates are what you could get as an investor, whether it's a bank or a non-bank, in the loan if it defaults by selling it in the open marketplace. Investor required rates of return. Historically, a little over 5% spread or risk premium over the government rate. And I'm going to come back to that in a moment now to show you the current situation and why it provides a dilemma to me and others as to why that current rate is so low. And there's also the spread on bank syndicated loans above the so-called government bond rate, a little bit higher, 5.7% historic premium. In other words, investors on average require a risk premium because they are investing in non-investment grade, higher risk companies. Next slide. Okay, for those of you interested, these are my criteria for various variables as to where we are in the credit cycle. So let's just take the default rate. If it's between 0 and 2.5%, it's a low default rate in that market. If it goes between 2.5 and 4.5 in that year, then it's kind of average. Remember, the average was 3.3. Stressed is 4.5 to 8, and greater than 8%, especially for more than 1 year, is a crisis. So where we are in the credit cycle, we can look at default rates, recovered rates, required rates of return, and try to determine where we are now, and more importantly, where we're going in the future. Next slide. Okay, this is a very important slide because it shows the high yield bond spread, this risk premium over time. And notice that back in 2008, 2009, in the beginning of the year, the required rate of return by investors when we were in a financial crisis was greater than 20%. Incredibly high. So if the government rate is 5% or 8% or whatever it was then the spread was more than 20% above that. Impossible for firms to pay over a long period of time. And so there was no trading going on. And the US market in particular was in crisis. Fortunately, that required rate of return dropped dramatically starting in the second quarter of 2009. And over time, you could see it wanders from above to below the historic average, which is around 5.4%. The most recent period that I have on my chart here was as of the end of June, end of the second quarter, but I can tell you what it is now, was that the high yield bond spread was around 4%, and the bank syndicated loan about 4.3%. I'm sorry, the high yield bond was around 3%. 3% spread. And bank syndicated loans, which had a higher default rate, about 4.3, compared to a historic average of 5.4. So low. And yet, there were many economists who were predicting a recession and problems. Why was the default rate risk premium so low? I have an answer to that. At least I think so. For one thing, interest rates were fairly high. And so a spread of 4% over a government rate of 4.3% still means a yield of about 8.3% on these high yield bonds. Pretty hefty and pretty attractive. But for me, the biggest reason is the competition between high yield bonds or bank syndicated loans and private credit. If private credit is increasing so much and taking market share away from high yield bonds and leveraged loans, then the underwriters from investment banks who are selling these products, high yield bonds and loans, are cautioning their clients not to offer or not to need to pay a very high interest rate to try to make them more attractive to investors. And this, I believe, had brought down the spread to, in my case, much below what it should be. In other words, in my opinion, the leveraged finance market now has much lower required yields than should be based on expected defaults and other variables in the future. That's my opinion. Next slide. This shows new issue volume, which is fairly decent in the first half of, that's 2024. I have to put in the first half of 2025, but it's a fairly robust market. So companies are still able to borrow money, even though the interest rates are higher. Next slide. This shows default and recovery statistics through 2024. I don't have too much time to go into it, but I would like to highlight two variables. If you look at the bond default rate in the very top, it was 1.7% if you measure it in dollars, and about 3% if you measure it in number of companies defaulting. That's below the historic average. So it seems benign for high yield bonds. But take a look at the third line, leveraged loan default rates. Wow, 5.7% or 7.3%, depending on if you measure it in dollars or number of firms. Way above the historic average. So here's a question for all of you. We have two markets, high yield bonds and leveraged loans. Both of them populated by non-investment grade companies. Why is the default rate so much higher for loans than bonds? Answer, very simple. Leveraged loans, or what's called bank syndicated loan, or broadly syndicated loans, are floating rate instruments. In other words, the interest rate that you pay floats mainly due to inflation and government rates, Federal Reserve rates in our country. But bonds are fixed rate. In other words, they don't vary. The interest rate does not vary. And most of these bonds were issued during COVID, when interest rates were very low. So guess what? The default rate is much lower on fixed rate bonds than on floating rate loans in the leveraged loan market. And that presents a dilemma for me as to which is a better indicator of where we are in the credit cycle. Is it above average defaults and below average recoveries, or is it below average defaults like the bond market? So let's pursue that. Oh, one other thing. The direct lending default rate so far is about 1.9% in 2024. And next slide, Mohammed, if you look at 2025 so far through the first half of the year, so essentially through just the end of last month, we see that the high yield bond default rate is 0.7% or 1.9%, depending on whether you do calculated by dollars or numbers, whereas the leveraged loan default rate, again, is much higher at 2.2% or 2.8%. So although the numbers are coming down a little bit so far in 2025 versus 2024, you still see a big difference between loans and bonds. Again, because of fixed rate versus floating rate. Next slide. Okay. One other thing about defaults. Now, this is perhaps technical, and you may not be interested too much in it with respect to since this is mainly data that is from the United States, which is by far, of course, the largest capital market in the world. But this is bank syndicated loans, a breakdown by the three types of defaults that we use to calculate default rates. Bankruptcies, missed interest payment or maturity payments when they come due and not cured in the grace period. Grace period is usually 30 days for bonds and 90 days for loans, and something called distressed exchanges. So this is a subject of some new research of mine. I don't have time today. Mohammed will clamp me down soon by saying I'm running out of time. But notice the percentage of defaults in the last column from these distressed exchanges dramatically increased in 2024 to 73%. That's in the last column in 2024, and 84% so far in the first half of 2025 of all defaults are these exchanges. So what is a distressed exchange? I don't know if you have that category in your own country, but let me define it for you. It's where a company has trouble in repaying its loan, maybe is on the verge of going bankrupt. So their lawyers send out a tender offer to existing creditors, asking them to accept an exchange of the old debt, which is coming due soon, for either new debt, which is the usual one, or it could be equity in the company as a substitute for the debt, or cash, but cash at a discount from par value. In all cases, whether it's a debt for debt exchange or an equity for debt exchange or a cash for debt exchange, the value to the old creditor is going to be less than par value. In other words, they're going to take a loss. The primary purpose used to be that these distress exchanges will forestall or maybe eliminate the possibility of a bankruptcy, at least in the short term. So my new research looks at what actually happens to these companies after they issue a distressed exchange, after they default, but they don't go bankrupt immediately. And the results of our study, which has not been published yet, is a remarkably high percentage of these companies do go bankrupt anyway within a few years. And so that's the summary of some of our findings. But what I'd like to point out to you is that companies now are adopting this distressed exchange as a means to avoid bankruptcy now during what is generally thought to be a fairly robust business cycle period in the United States, with growth rates much higher than most GDP levels in other countries. So that's why a deep dive into the distressed exchange market is really important in terms of new research. And I'm not the only one looking at it, but we have some very, very interesting data. Next slide. Just to show you, this is high yield bonds, that was loans, and they are 73% in 2024 were distressed exchange of defaults, and so far 62% in 2025. So a continuing trend of distressed exchanges becoming the dominant type of default in the US credit market. I'm wondering, is it possible in your country for a company to go to their creditors and offer an exchange of the old debt for a new type of debt? And let me point out one area that is getting tremendous amount of controversy and interest in the US now, and you may want to read up about it. It's called liability management exercises, LMEs. Basically, it's where one group of creditor provides some relief to companies, but in exchange, they eliminate the minority creditors from participating in the exchange. It's called, another name for that is called creditor violence, or bankruptcy battles, or bankruptcy warfare. Anyway, there's a lot going on in the change in the way creditors, whether they be the original creditors or distressed debt investors who bought the debt as the firm gets more distressed, and they tried to take advantage of minority creditors. In my opinion, it's a really unfortunate trend, and it shouldn't be allowed, at least in most cases. Next slide. This is some of the summary of results. We found that 53% of all distressed exchanges over an extended period of time, on the top part, 53% of bonds and 42% of loans end up having problems afterwards, either a bankruptcy or a missed interest payment or a distressed exchange again. Next slide. The last thing I want to talk about now. Keep going. I'll tell you when to stop, Mohammed. Keep going. Keep going. Okay, stop. Good. So now let's get to the question I asked you at the start of the discussion. Now that you know something about the credit cycle, at least the way I define it, and of course you are familiar with the business cycle, which, if any, leads the other in terms of timing. Does the credit cycle lead the business cycle, or the business cycle leads the credit cycle, or are they coincident? I'd like to ask you to raise your hands, but it's kind of difficult here. How many think the business cycle leads the credit cycle? Because that's what most economists think. And how many, however, think the opposite, that credit changes take place before business cycle changes? And how many think they basically move together? Well, this chart, I think, answers the question, at least for me. The yellow bars represent recessions in the United States and the period of time that we had a recession. So we've had 7 recessions since the 1970s, most of them quite short, some of them more serious than others. And the solid line represents default rates in the high yield bond market. And what we notice is that the default rates, and particularly in the area that has the ovals on it, default rates generally start out at below the historic average. So back in 1988, 89, 90, they go from below the historic average to much above the historic average and peak at the end of the recession or near the end. If you look at the recession of 2001, 2002 in the center of the graph, you'll see that the default rate actually starts rising from below to above the historic average 3 years before the recession. And the recession of the great financial crisis of 2008, 2009, again, it started but 2 years before. And then you have the short recession of COVID. And then finally, the question is, where are we going from here? But up to now, it appears to me that the credit cycle seems to move in advance of the business cycle. The business cycle being change from expansion to recession. And peaks naturally when you have a recession. So perhaps, and I believe it's true, the credit cycle is a leading indicator of the business cycle. And so now the question is, where do we go from here in the United States? Because the right-hand side shows that the default rate looked like it was rising and was rising during COVID, but then fell dramatically and now is well below the historic average if it's high yield bonds. But the next slide, if you show the next slide, shows you the same data using bank loan default rates. Next slide, Barman. Yeah, thank you. And the bank loan default rates of late are much higher. So which is really the appropriate indicator? Normally, the two move together, but not, as I mentioned before, in the current period. So there's been very much volatility in prediction of a recession in the United States. It went from very low to quite high, particularly after Trump issued the first tariff increases in early April of this year. Then about 65% of economists thought that this would lead to a recession. Now, with the settlement of the tariff picture in some countries, like Japan, expected to be Europe, Philippines, the prognosis of a recession is probably now well below 50% probability. But if you look at default rates on leveraged loans, that certainly seems to be predicting a recession coming on. And the bankruptcy data seems to show problems in the corporate sector much more than interest rates and high yield bond default rates. So let me close by thanking you for your patience. I hope that the discussion of the credit cycle and private debt and various other aspects of defaults and recoveries, something that I have great passion to follow, has been of interest to you. And I don't know, Mohammed, if you generally have questions or not, but I'd be happy to take a few in the short time we have remaining.
Thank you very much, dear Professor Edward Altman. Thank you very much for your contribution and your effort. It's really an excellent presentation, presentation. Now, if anyone have any questions, you can open your mic and ask your question. David, you have? Yes. Now, if anyone have any questions, you can open your mic and ask your questions. David?
Yeah, it's mainly a comment. So thank you very much for the background for the private market and the credit. I've put in two sort of comments for background to Australia. One is a very large failure, which is about $1 billion US, $1.5 billion Australian dollars, and a discussion paper from our company regulator or financial regulator, ASIC, because this, I mean, as you mentioned, it's a private market, so it's unlisted.
Right.
So it's very few people are allowed to invest in it. And you talked about feeder funds and what have you. So part of our superannuation or pension system, those funds are investing members' money in
Right.
this private market.
Yeah, also
so it's not
ours
just,
in pension funds too.
Yep. And it's essentially in Australia, it's I call it lightly regulated. I mean, most people would know of prospectuses for listed companies. So we've got rules that you don't need prospectuses if you issue securities to, we call it gold card, but it's people who know what they're doing, sophisticated investors,
Right.
although that's a term for something else. But if you invest 500,000 Australian, which is about 350,000 US dollars at a go, then it's buyer beware. You don't have to have a prospectus to issue it. So people just invest in it, but obviously you have to have a lot of money to invest in it. So there's questions about, what about the rest of the market, the retail people who
Right.
don't directly invest in it, as well as the protections, because you don't have the prospectuses and the market announcements and keeping the market up to date. So all what you've talked about the credit cycle feeds into that, because where is the credit cycle, and do you have enough information to work out where that company is in the credit cycle and all the distressed debt.
And you said there was a big filer, a bankruptcy filer of a private credit firm in Australia?
Yeah, I put a link to it. No, it's a big company rather than the feeder fund and what have you. But it's someone who's borrowed on the private market for about $1 billion US and has crashed and burnt and basically no money left.
Are they borrowing from Australian private credit or from US?
Don't know. Probably Australian by the reference, but I haven't got into it.
Because one question that I would have if I was Australians, like central banker, or worried about this, the local credit market, is how much exposed are the banks in Australia to private credit? Now, I don't know if they're looking at that in Australia, but they are looking at that very carefully in the US and now also in the EU. I read an article in the Wall Street Journal about 1 month ago when I was on a lecture tour in Europe. And it was an article about how the European Central Bank now is increasing their focus on stress testing the banking system for problems in the private credit market. Even though, like you said, they are very lightly regulated. Now, interestingly enough, some of the private credit firms are regulated more than others. And those are the ones that are issuing equity in the US market because they are regulated by the SEC. But most of the private credit are private funds. And so if they're not issuing in the public markets their own financing, then they are not subject to very much regulation. And this is where we have to be careful, because banks may be lending to these privately owned private credit firms, and also, as you point out, pension funds and insurance companies. And to what extent are they exposed? The other question, David, that I didn't bring up, but now you give me the opportunity, is do we have good data on default rates of the private credit firms?
Yeah.
And here's the issue. In the private credit area, some of the firms, many of them actually recently, have a clause. It's called a PIK toggle clause, TOGGLE. And PIK means payment in kind. So the firms that borrow money from private credit have the option of paying interest in dollars, or if they don't want to pay it in dollars, they can pay it in more debt. Payment in kind.
Yeah. And
clearly, if a firm switches from dollar payments to non-dollar payments, it's a sign of distress. And guess what? It's not considered a default. So they don't count it as a default, And the default rate is then underestimated because these firms essentially are defaulting on not paying cash anymore, but they're not in a formal default or bankruptcy situation. And what we're finding, at least in 2024, and I haven't looked as carefully in the trend in the last month or two, but more and more of these firms are switching from cash pay to interest being more debt being paid. And so are they really non-defaulted companies? Keep that in mind when you take a look at the private credit industry. Is it possible in Australia to switch from interest to payment in dollars or payment in new debt? And of course, the problem is, if it's an issuing of new debt, will they ever pay that new debt off?
Well, because I sort of came across the private company market being a little bit bigger than I thought when there were people talking about blockchain and monetizing this private company debt investments that they're making, and thinking, oh wow, start getting into that, and then it's like, and then what you're talking about is like, what in the hell are you investing in?
Well, thank you very much for your question, and I haven't visited Australia since COVID, but started, but it's one of my favorite places in the world. It is a little far away from New York, but lots of friends there, and would love to visit again. So thank you very much.
Yeah, thank you.
Any other questions, Mohammed?
Yes, Ahmad Ramadan, you can open your mic and ask your question. Ahmad?
Okay.
Yeah.
Okay. Good evening, Professor.
Akbar, where are you from?
I'm from Egypt.
Egypt, okay.
Yeah. I have two questions. First one is related to this subject, and another one is out of subject. The first one is what the difference between sustainable bonds and green bonds, and how then make the cost of company low. This is my first question. The second one is, it is important.
I'm sorry, I'm having trouble hearing you, Akbar, because of noise in the background. Could you repeat the first question again?
Okay, my first one is, there any difference between sustainable bonds and green bonds, and what is the relationship between them, and make the cost of company low? Okay.
So the question is the relationship between green bonds and regular bonds?
Sustainable bonds.
Yeah.
Okay. This is my first question. My second one is about behavioral finance. We haven't measures about behavioral finance, how it's important, and how create measures like standard finance.
Yeah. Okay, that's second question is actually really interesting and important, not only for the question of behavioral finance, which is a subject matter that I'm no expert on, but I know that there's a lot been written by academics, particularly over time. By the way, are you an academic, Akbar, or a practitioner? I can't hear you.
Ahmad, you academic or practitioner?
I'm a teaching assistant in Helwan University.
Okay, so you're more of an academic. Well, I think the question of green bonds is relevant, of course, to companies that issue them. And most of the research that I've seen seem to imply that the credit risk of companies that are using it for, let's say, sustainability reasons rather than normal business reasons, doesn't change very much the credit risk of the company. And the yields on them are basically similar, maybe slightly lower, because of their destination of the funds. So I would say the credit risk of companies, whether they are green bonds or not, should be based on traditional and non-traditional analytics. And that leads to the second question, this behavioral finance. And what I'm talking about here is, maybe it's not the same exactly what you're thinking of, but is the importance of non-structured variables in determining the credit risk of a company. What I mean by that is not data from financial statements, not data from balance sheets, income statements, cash flow statements, but data that leads coming from, for example, management attributes, governance of the company, carbon footprint. And more, this data is being generated from artificial intelligence sources. Data analysis coming from company reports, coming from news items about the company, coming from filings of the company with respect to boards of directors, etc. And increasingly, we at Wiserfunding are looking at these non-structured data coming from AI primarily into our models, and we're finding that they add value to the accuracy of the models of about 10 to 15% increased accuracy. In other words, especially for small and medium-sized firms, they are more and more important than, say, they were if you only had a model that used only financial data. And for me, this is an example of modern technology, if you will, adding to the credit evaluation of companies. And you call it behavioral finance, so maybe it has to do with, for example, things like hiring or firing of personnel, or relationship between how long the people are working in the company, tenure, things like how long the company's been in business, the experience of management. Thank you for the question on behavioral. For me to jump from that to AI and its impact on credit evaluation tools, which we are at Wiserfunding using quite a bit now, and finding there is value added to it. And I'm going to be lecturing in the Gulf region in, I don't know if you have anybody listening from Saudi Arabia or Dubai or Abu Dhabi or Oman listening, but I'll be in the region in October to speak to that issue about AI importance in credit evaluation models. I think we're about out of time, Mohammed, but maybe there's one more question. And
yes,
then,
Dr. Saad, the last question. Dr. Saad Mtawa, you have a question? Please ask. Okay, can you hear me? Dr. Saad Mtawa, please open your mic and ask your question. If anyone have any questions, you can open your mic and ask your question. Yes, you can ask now, dear bro. Dr. Saad Mtawa, your mic is unmuted. You can ask now. If anyone have any questions, you can open your mic and ask your question.
Mohammed, I think it's time then to say goodbye and thank everyone for their interest, and look forward to hearing from you if you want to send me a question by email.
Yeah, thank you very much, dear Professor Altman. Thank you very much for your contribution, and thank you everyone joining us today. And thank you very much for taking the time to present it to us today. It has been appreciated. Thank you very much. And I hope to see you soon in Egypt. You are very, very welcome.
You're welcome.